Is it possible that the Fed, which stayed at the easy party too long, could stay at the tight party too long? Could the pendulum swing, and could they make a mistake that way? It would just seem fitting and so symmetrical.
Yeah, Joe. So in terms of what we're expecting is kind of just that. The Fed is going to likely overdo things here. And if we look at their projections from the meeting, their most recent meeting, you can see that they're at maximum uncertainty across almost all of the components that they're forecasting right now. And they're still going at this very aggressive clip of rate hikes. We are expecting at least another 75 basis point rate hike for them to deliver. It's almost like them going at 75 miles an hour without necessarily knowing where the next turn in the road is ultimately going to be.
That's perfect. That's fitting. So they really don't know what they don't know, but they've admitted that. I would think that's the first step towards. I would think that's the first step towards recovery, is admitting it. But then I'd slow down to maybe 35 or 40, and that's not what's happening.
Well, that's right, because what they do know is that they need to get inflation under control. And ultimately, what they need to do here is inflict some pain on financial conditions to basically get that cooling that they desire on the labor market. They're kind of using a nice term for this, right? Rebalancing the labor market. But what ultimately this means is they need to drive unemployment higher. It's an unfortunate cost of this, but ultimately, because we face very strong demand inflation here in the U.S., this is the medicine that effectively the economy needs to take here.
Well, I'm going to get to Sherry, but just one last thing. Yeah, we have that now, but the participation rate is low, and we paid people to stay at home, and now everybody is talking about hybrid work. I don't know if it's really the classic tight labor market that we saw. So they may be going after the wrong thing, and you may end up hurting the rest of the economy for what wasn't a classic labor market, a tight labor market that we've seen in the past.
Certainly, Joe, but what they're in the process of doing now is ultimately winding back a lot of that accommodation that we saw post-COVID. You mentioned in particular, the fiscal stimulus that we saw. They're in the process of winding that back, and the Treasury market now has to digest more debt than really it has been over the past couple years, with the Fed not in the market anymore. And this is causing a lot of problems for the Treasury market that we've seen really over the past couple days or so, just the incredible rate volatility that we see in U.S. Treasury, supposedly the most deepest liquid market in the world.
And Sherry, I don't think you should switch yet to fixed income. Stick with for managing wealth. But 430 is not bad for 2 years. You got to admit that. That hasn't been something you had to worry about before. I think at this point, Sherry, you make a good point. You want a rebalance next time you think the market's at a point where it could be bought, and rebalance with stocks that will do better in an inflationary rising rate environment. Should we do that and actually buy some things?
Yeah, look, I think we're at a crucial moment where we really need to get investors out of the old party scene of the Fed and into the new party of forward thinking around profits and earnings, and step out of the economics of the politicized bond market and really take a look at what the opportunities are in the science of the stock market, which always tells us that winners become losers and losers become winners. We're in a market reset right now. We've got 11 sectors of the S&P 500. 30% of the stocks on the market have already retested their lows. Regardless of the debate around the broader market retesting lows, it's a buying opportunity for many people. And if I had a choice between stepping into the politics of the bond market or capitalism in the stock market, I'll take the stock market every day.
You're preaching to the choir here. And you're talking about today. So these issues that you're talking about have already retested the lows enough to where you feel comfortable buying right now and recalibrating your portfolio. Okay.
That's right. The biggest thing, though, I would encourage investors to understand, we're in a massive leadership change that in the 20 plus years I've been managing money, we've got to take stock of that. So you want to barbell portfolios towards present value cash flows, and then anchor the far into your portfolio against what I call idea maturation, centered on innovation, but present value cash flows moving from dividend payers, not enough. We got to move to dividend growers on the front end of portfolios, and then center within sectors, separating out staples like tech staples versus tech innovators, healthcare staples versus healthcare innovators, and further sort of delineate that within your sector choices. And obviously the security level is crucial.
Shepard Smith here. Thanks for watching CNBC on YouTube.